Have you ever wondered why billionaires seem to pay such low tax rates? What if someone told you their properties actually help them pay almost zero taxes? And how is it possible that the ultra-wealthy keep growing their net worth while barely touching their bank accounts? I'm Bernard, and I turn my financial research into fun videos. Recently, I've been diving deep into a fascinating tax strategy that's been hiding in plain sight. Right now, most Americans are stuck in a brutal cycle of earning and paying taxes, watching nearly half their income disappear before it hits their bank account. Meanwhile, a select group of savvy investors has discovered a completely legal way to grow wealth while minimizing their tax burden. The conventional wisdom says you need to maximize your deductions and hope for the best come tax season, but that's like trying to bail out a sinking ship with a teaspoon. There's a much more powerful approach that the wealthy have been using for decades. Here's what you're going to learn today: how to legally transform taxable income into tax-free wealth even if you're starting with a regular W-2 job. The exact strategy I used to create $199,000 in tax deductions last year, even if you don't have much capital to start. Why timing your borrowing is crucial for this strategy to work even if interest rates seem high right now. The 3 specific types of assets that make this strategy bulletproof even if you've never invested before. Step-by-step blueprint for implementing this strategy, customized for your situation. Let me show you how this works. Let's dive into the strategy that's revolutionizing how smart investors think about taxes and wealth building. What I'm about to share isn't just theory, it's a practical approach that's being used right now by some of the most successful investors in the market. 1. The fundamental tax asymmetry. Here's something that changed everything about how I view money. Not all dollars are taxed equally. Your salary gets hit with some of the highest tax rates in the system, while other forms of money movement barely get touched by the IRS at all. Want to know the most fascinating part? When you borrow money, it's completely tax-free. Think about that for a moment. You take out a $500,000 loan, and the IRS doesn't want a single penny of it, but earn $500,000 in salary, and you're looking at paying nearly $200,000 in taxes. Now you might be thinking, but Bernard, a loan isn't income, I have to pay it back. And you're absolutely right. But here's where it gets interesting. What if you could use that borrowed money to buy assets that generate enough income to cover your loan payments and still put cash in your pocket? Let me show you a real example. In 2022, I borrowed $1 million at 2.5% interest through a portfolio line of credit. That's about $25,000 in annual interest. The assets I purchased with that money are now generating enough revenue to cover not just the interest payments, but also building equity and appreciation. And remember, I didn't pay a dime in taxes on that $1 million. 2. The 3 pillars of strategic borrowing. Before we go further, you need to understand the 3 crucial elements that make this strategy work. I call them the 3 pillars of strategic borrowing, and missing any one of them can turn this powerful strategy into a financial disaster. The first pillar is timing. You want to borrow when either interest rates are historically low or when you can earn a significantly higher return than your borrowing cost. Right now you might be thinking, but interest rates are high. That's true, but remember, we're playing the long game here. There will always be cycles of opportunity. The second pillar is purpose. This is where most people go wrong. Every dollar you borrow needs to go into what I call a 3x asset. That's something that can generate 3 times your initial investment within 3 years through a combination of tax savings, cash flow, and appreciation. Notice, I didn't say buy a nice car or take a vacation. The third pillar is structure. This is the game changer most people miss. You need to structure your investments to maximize tax advantages. This brings us to the most powerful tool in our arsenal: real estate. 3. Real estate as the ultimate tax shield. Now pay close attention because this next part is where the magic happens. Real estate, particularly short-term rentals, offers something no other investment can match: the ability to create paper losses while building real wealth. Let me break down how this works with a concrete example. When you buy a $500,000 property, the IRS allows you to depreciate it over time. But here's the kicker: through a strategy called cost segregation, you can accelerate this depreciation and take massive deductions up front. In 2024, you can take 60% of these depreciation deductions in the very first year. Let's say your cost segregation study shows $200,000 in depreciable components. That means you could potentially deduct $120,000 from your taxable income in year one. If you're in the 37% tax bracket, that's $44,400 in actual tax savings. But wait, it gets even better. If you qualify as a real estate professional for tax purposes, these paper losses can offset your W-2 income. The qualification isn't as hard as you might think. You need to spend 750 hours per year in real estate activities and more time in real estate than any other occupation. For couples, only one spouse needs to qualify. 4. Risk management and protection. Now, I know what some of you are thinking. This sounds great in theory, but what about market crashes? What about 2008? This is exactly why we need to talk about risk management. First, let's address the elephant in the room. Yes, this strategy involves debt, but it's not about maximizing leverage. It's about optimizing it. Here's my 3-part risk management system. First, every property must generate enough cash flow to cover its debt service with at least a 25% buffer. This isn't just about making the monthly payment, it's about having room for unexpected expenses. Second, maintain a cash reserve equal to 6 months of total debt service. This isn't exciting, but it's your insurance policy against market downturns. Third, focus on markets with diverse economic drivers. Don't put all your properties in one area or one type of asset. My portfolio includes short-term rentals in tourist areas, mid-term rentals near medical centers, and long-term rentals in growing metropolitan areas. 5. Implementation blueprint. Let's get practical about how you can start implementing this strategy. Everything I'm about to share is based on actual deals I've done, not theoretical concepts. Start with your first property purchase. Look for something in the $300,000 to $500,000 range. Why? Because this price point usually provides enough depreciation to offset a significant amount of 1-2 income while still being manageable for most investors. Get a cost segregation study done immediately after purchase. This is crucial. Don't wait until tax time. You want to know exactly how much depreciation you can take before you finalize your deal structure. Structure your financing to maintain at least 25% equity after your initial purchase. This gives you room to refinance later if better rates become available. Now, here's the key part that most people miss. Document everything about your involvement in the property. Remember those real estate professional requirements? You need to prove your hours. So keep detailed records of every minute you spend on your real estate activities. As your first property starts performing, look for your next opportunity. The goal is to create a cascade of tax benefits while building real equity. Each property should either provide significant tax benefits, strong cash flow, or substantial appreciation potential. The best deals offer all three. Don't just rush out and start borrowing money. Take time to build your knowledge base. Join local real estate groups. Network with other investors. Learn from their successes and failures. Remember, the goal isn't to grow as fast as possible, it's to grow as smartly as possible.